think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I am your host, Daryl Thomas, and today we are interviewing Brent Johnson. Brent Johnson is the CEO of Santiago Capital. He is well known for the dollar milkshake theory and is often seen as a contrarian to many of the brilliant minds that we engage with on this channel. Today, we're going to talk to Brent about where he sees the dollar going, what are his thoughts about gold, Bitcoin, inflation, recession, and many of the other topics that comes up in our current economic environment. So be sure to hit the subscribe button, hit the like button. I would love to have your support for this channel as I'm bringing this free content to you. Now, without further ado, let's get to the interview. Hey, Brent, I appreciate you coming on the show today.
Thanks for having me. I enjoyed meeting you in New Orleans and looking forward to talking to you here.
Yes, indeed. Yes, indeed. So I didn't know much about your background, and from a recent interview I watched that you did, you used to be at Credit Suisse, and so or Credit Suisse, or however you say that, right? And you were there during the global financial crisis, GFC.
Yeah, so I was very fortunate when I was in grad school. Credit Suisse, depends if you're in France or I guess if you're in America, whether you say Swiss or Suisse. But Credit Suisse was my dream job, and through some fortunate breaks along the way, I ended up working for them for several years. And I started with a firm called Donaldson, Lufkin and Jenrette in New York City, and I moved to San Francisco with them. And about a month after I got to San Francisco with DLJ, Credit Suisse bought DLJ. And that was kind of at the height of the dot-com boom. And so then I was with Credit Suisse for almost the next 10 years and, experienced the real estate boom and then the global financial crisis while I was at Credit Suisse.
So what was going on, in your mind, your loved ones? I'm sure you knew a lot of people were probably panicking and maybe had questions for you. What was that sentiment like during that time?
Well, probably like a lot of people, the global financial crisis was a very pivotal moment in my life, career, outlook on the world, however you want to describe that. And there was a couple things that happened between 2007 and 2009, kind of on both sides of the global financial crisis. And I'll take just 2 minutes and I'll tell you this story. So I had kind of a fortuitous meeting prior to the global financial crisis, and this young couple, potential clients, had sold their company, and we were kind of pitching them on letting us manage their assets. And these people were extremely smart. They weren't educated in finance, but they were extremely smart. And they came in one day and they were asking all these questions about the rate of inflation and the rate of growth and how much interest was on the U.S. national debt. And, all these questions that I had never really dealt with before. And I was kind of embarrassed that I didn't know the answers, but I was even more embarrassed that all the managing directors that I had brought in, kind of the experts to speak to this couple, they didn't know the answers either. And then this couple started asking about real estate derivatives and was that going to be a problem, and mortgage-backed securities. And again, I couldn't answer the question, which I was embarrassed about, but I was even more embarrassed when my bosses couldn't answer this question.
Sound like they read Peter Schiff's book or something.
Yeah. Well, they had read a book, and again, they weren't necessarily educated in finance, but they knew what they didn't know, and they knew the right questions to ask to try to figure it out. So, long story short, that meeting led me to try to figure out how to answer these questions myself. And as a result of trying to figure out how to answer these questions myself, I became aware that there was a problem. Now, I was not smart enough to figure out that we were going to have a global financial crisis, and I wasn't smart enough to figure out to short the banks as a result. So I didn't really profit from the global financial crisis, but I was ready for it. And I positioned my clients in a way to where we didn't get wiped out the way a lot of other people did as a result. Now, on the other end of that was pre-global financial crisis. Now, coming out of the global financial crisis, kind of really towards the end, There was one of the top guys from Switzerland came, and he was doing a road show and visiting all the different offices in the United States. And he came in and visited us, and he was, kind of giving us this big pep talk and how we have to stay the course and everything's going to get better and don't worry about things and, keep our clients invested and all this kind of stuff. And at the end of the thing, he said, does anybody have any questions? And nobody asked any questions. And that kind of made me mad that nobody asked any questions. So finally I said, okay, I'll ask a question. And I said, how are you managing your money? Because this is a very wealthy guy, very sophisticated, financial, very connected. And I asked him how he was investing his money. And he said, well, I have a lot of real estate. I have a lot of gold. I have a lot of cash. And this was basically not the opposite of what we were supposed to tell our clients to do, but it wasn't in line with what we were supposed to tell our clients to do. And both of those things bothered me. It bothered me that the super masters of the universe ahead of the global financial crisis didn't see it coming and couldn't answer the questions when they were asked. And then on the other end, again, these financial experts were doing the exact opposite of what they wanted us to be telling our clients. And so I went from a position to where I had the job I've always wanted to a job that I just couldn't stay there anymore. And so I ended up leaving Credit Suisse post global financial crisis. So it was a pretty, like I said, pivotal time for me. And it really changed my outlook on things. And I decided at that point that I was going to be an advocate for my clients rather than a salesman for a big Wall Street firm.
Yeah. Yeah. So it sounds like there was a conflict with your own ethics and values and how you wanted to treat your customers and things of that nature.
Very much so. Very much so. It was a very enlightening. I learned a lot. I mean, I wouldn't change it for $1 million. I mean, the education that I gained by being with a firm like Credit Suisse over a 10-year period and going through the dot-com bust, the Renaissance, and then another financial crisis and seeing it from the inside was something that, most people, they read about it in a book, but I was able to sit there and watch it. And so it was an invaluable experience for me.
Yeah. Yeah. So that's good. And what was your path to getting there? Was it like something like straight out of high school? Like what was kind of like?
No, the funny thing was I was on a couple different paths before I finally decided I wanted to work. I kind of always wanted to work in business and I kind of always wanted to work on Wall Street. But the thing is, I didn't even know what Wall Street was. If somebody asked me what a stock was in college, I wouldn't have been able to tell them. But I kind of decided towards the end of college that I did want to work in finance. That by that time I'd kind of figured it out. I decided I did want to work on Wall Street. I wasn't able to get a job on Wall Street right out of undergraduate because I didn't have a business degree and I didn't have any contacts in New York. So I went to business school right after undergrad. And the business school I went to was a very good school. It was an international business school. It was the #1 ranked international business school. It was a school called Thunderbird in Phoenix. And but it wasn't really known for finance, and it wasn't really known as a track to get into Wall Street. It was known for international managers around the world. If you were going to be a brand manager in Brazil, or if you were going to do marketing in Europe, it was a fantastic school, and a lot of global corporations recruited from there. But afterwards, I just decided I wanted to move to New York, and I started making phone calls, and I didn't get a job on Wall Street. I got a job with in the corporate audit department at Philip Morris, which was a huge global company. And they moved me to New York, and I worked there for 2 years, and I didn't like the job, but I learned a ton. And I think if anybody's listening, trying to figure out how they're going to get where they want to go, you're not always going to get the job you want right away, but whatever job you have or whatever situation you're in, try to learn as much as you can from it. Because it turns out that while I hated being an auditor for Philip Morris, years later, I used a lot of the things that I learned at Philip Morris to help me further my career in investment banking and financial management. So anyway, it wasn't a traditional path for me. I had to cold call to get in and get a job, and I had to beg people for a job, and I finally got one. So persistence kind of paid off, but it wasn't a traditional, you go to an Ivy League school and you get recruited by Morgan Stanley. I wish it was, but it wasn't that easy for me.
Yeah, yeah. So it sounds like you were building on these pillars that ultimately you'll come back to later on in life and in your career that proved to be very valuable.
Absolutely. And again, I think, it wasn't the path that I would have chosen, but it turned out to be in hindsight, it turned out to be a pretty good path. So, I guess it's always is try to find the silver lining in everything, I guess would be the takeaway.
Yeah, yeah, definitely. All right, so you're well known for the dollar milkshake theory, and me listening to it, like I believe I get it, quite a bit, and I can see how that could play out if we were to have a huge deflationary bust or whatever, right? I just wanted to get your take on inflation. I mean, like right now,
Yeah.
the numbers continue to go down. Like there's a lot of hype around the numbers going down. Markets are rallying, and we still have this issue with energy supply and things of that nature. Where are you at with the whole inflation narrative?
Yeah, so I think one thing I would say, and I think this is something that a lot of people miss, and understandably so, because listen, this is a very complex world. It's very confusing. A lot of the stuff you have to figure it out on your own. Nobody teaches you this stuff, unfortunately. But one thing I would say with the dollar milkshake theory, for those who don't know what it is I think the dollar is going to get much stronger in the years ahead, whereas a lot of people think it's going to get much weaker due to inflation and all the money printing that the government will do. And then a lot of people will automatically assume that that's a deflationary thesis. And it's not necessarily. It could be, but it's not necessarily. And what I mean by that is when you understand the design of the monetary system, we have a debt-based monetary system, which means we have a monetary base, and these are the reserves, the savings account, however you want to think of that, of the banks at the Federal Reserve. And then it's all the currency and coins that exist. But all the other money in the world is loaned into existence using that monetary base as the collateral. And so in order for the system to survive, it has to grow. And I don't have time to go through and tell everybody why that is, but just trust me, that's for the system, for a debt-based monetary system to continue to function, it has to grow. The debt has to grow. The credit has to continue to be extended. If it doesn't, then that's when you get deflation, where you get defaults and money starts to disappear. As these defaults start happening, then prices come down. And so the thing that I'd like to point out with the dollar milkshake theory is, even though the US government will have to print money, do bailouts, do stimulus, and they've had to do this many times over the last 20 years, and they'll probably have to do it many times over the next 5 or 10 years, the rest of the world has to do it as well. We're not doing this in isolation. If we were the only country with these problems and the only country doing it, then I would expect the dollar to fall. But currencies trade relative to each other. And so if the US is doing all these bailouts and printing money and providing stimulus, and the rest of the world is as well, then you get a lot of liquidity, and that pushes asset prices higher, and you have the potential to get inflation from that. And so here's the thing is, even if the dollar is rising versus other currencies, if the whole world is providing stimulus, you can have the dollar rising in an inflationary environment. And if you doubt this, just look back to last year, 2022. The dollar hit its highest level in 30 years, and yet we had the highest levels of inflation in 30 years. So it's a little bit counterintuitive, but I think if you understand that the way that central banks and governments fight deflationary pressures is that they provide a lot of stimulus, they increase the monetary base, they increase the supply of money, you get these tailwinds of asset prices going higher, and you could argue that that's an inflationary tailwind. But because of all the bad debt, you always have to be ready for these deflationary shocks along the way. And so I don't really like to think of myself as an inflationist or a deflationist. What I really like to think of myself as someone who just understands the inner workings of how the system is actually designed and trying to be prepared for all of them. And the other thing I would say is, again, for people who think that the dollar just can't possibly go higher because of all of the stimulus the government will have to do, let's just go back to the global financial crisis. Think about all of everything that's happened since the global financial crisis, all the different QE, all the different monetary policies, all the different stimulus, all the different bailouts. And yet the DXY, the dollar index, which is a measure of the dollar versus other currencies, the dollar is up 30% since 2008, despite all of this money printing and all of this stimulus. So again, if you step back and you look at the data, just look at the cold hard data, you will see that while the dollar may have lost purchasing power against real things, it's gone up a lot. And so there's inflationary tailwind. it's gone up a lot against foreign currencies. That causes deflationary pressures, which can lead to these deflationary shocks, which we had in 2008, which we had in 2018, which we had in 2020, and which we had in 2022. And so, these shocks will show up from time to time. And you just really, in my opinion, you have to be ready for them.
Yeah. So that makes a lot of sense, because I was even, thinking about, 2022 when the dollar got very strong and against a lot of the other assets. I mean, gold dropped significantly. Many of the stocks dropped significantly. And if you were in dollars, you could buy more of those assets, which are dollars.
That's right.
So that makes total sense. So what is your take on, like, okay, the dollar gets stronger. So are you more in the camp of like positioning yourself with having more liquidity, waiting for a bigger shock or deflationary shock when the dollar gets stronger? Like, how are you mostly like positioned?
Yep. So I manage money for individuals. So I'm not managing pension funds or big retirement, endowment accounts, or for other big institutions. I'm managing money for individuals, and a lot of the people that I manage money for, they've been very fortunate. They've made a lot of money. They've made a big nest egg, and so they want me to try to help them protect it and then grow it in a prudent manner. And so I'm always looking for ways to make money, but I'm always looking ways to protect on the downside as well. And because remember what I said a few minutes ago, is that they're always providing stimulus, or the monetary system has to grow in order for it to function. And so over time, the monetary system grows, the monetary base grows, the money supply grows, and that provides a tailwind for assets. And I think most people know that if you study the history of fiat currencies, they lose value over time. And as a result, because fiat currency loses value over time, assets rise over time. And so knowing that, I don't want to just be sitting in cash. And so we own a diversified basket of assets. We own equities. All my clients own real estate, precious metals. We've got some short-term fixed income because yields are high now, that you can actually get a return for sitting in cash and having liquidity. And then we have some soft commodities that we're exposed to as well. So we're actually positioned for asset prices to go higher. However, as I mentioned, you always have to be ready for these deflationary shocks. And so from time to time, I will put hedges up. Well, we have a hedging overlay on the entire portfolio, and sometimes we'll have more hedges than others. But what we try to do is we try to ride that wave of assets going higher over time. And then through kind of a dynamic hedging program and a volatility overlay, we try to protect against these violent shocks to the downside. And by being prepared for these violent shocks to the downside, we don't become distressed sellers, and we can actually use that liquidity that we have in order to be distressed buyers. And so I would say right now, where we're at in the cycle, I think equities are going to go higher over the next couple of years. However, I think in the near term, whether it's over the next 6 days or 6 months, I don't know. I wish I did, but I don't. I'm not smart enough to know that. We have a number of hedges that we think will protect us, because we think in the short term, there probably is going to be a pullback in asset prices kind of into, let's call it end of Q1, end of Q2 of next year.
So when you say pullback, are you thinking more recession? I mean, there's these debates on like whether soft landing, hard landing, things of that nature. I mean, we're seeing some of the data come out that still look recessionary. And so are you thinking recessionary, or like what are your thoughts?
I don't know. And this is and the reason I say that is because whatever happens, so let's say that there's a downturn. And let's say it's let's say it's a 25% downturn in equities, and unemployment starts to rise, and we start to have some defaults. The government, the Fed, and when I should say this is not just in the US. This happens outside the United States as well. It's really important to understand that, because as many problems as we have, I think the rest of the world has more problems than we do. But if that does happen, the Fed and the government, they're not just going to sit back and let it happen. They will react. They will provide stimulus. They will provide some kind of a support. And it's impossible for me to know exactly what they will do. And so I will kind of have to wait and see what they do when they do it in order to figure out whether I think this is going to be a sustained downturn or whether it's going to be another V-shaped recovery, such as we had in 2022 and in 2020. I'm not somebody who's a perma bear who thinks that equities are going to fall 75% and they're going to stay down for 10 years and we're going to have another Great Depression. I think what's more likely is we'll have a very hard downturn. We'll get a change in monetary policy. Asset prices will start to rise again. And then I think we're going to have a global debt and currency crisis. And that is going to cause all kinds of problems. And in some ways, I think it has the potential to drive capital into the United States from abroad. And as that capital comes into the United States from abroad, that has the potential to cushion the downward trajectory of U.S. asset prices. So again, I try not to perfectly call everything. What I really try to do is just be prepared for everything. And because I think the rest of the world has even more problems than the United States does, I still think that the United States will be seen as a relative port of safety in the storm. Now, that doesn't mean it will be good here. I'm not predicting runaway growth and rainbow and all kinds of just perfect weather. I think we're going to have some real struggles. But if I look around the world and decide where I want to allocate capital, I would much rather allocate capital to the United States than to some other country around the world.
Mm-hmm. And so with the United States, obviously the concern there is with the debt and deficits. So do you see a path for this going down? A lot of times from what I've heard is that usually inflating away the debt was a way that they've done in like the 40s and such. And then obviously when we compare inflation in the 70s, we didn't have as much debt then. Our debt to GDP was lower. How are you seeing that play out in terms of is the debt going to just continue to increase or
I think the debt's going to go much higher, much, much higher. But again, I don't think it's only going to go higher in the United States. I think it's going to go higher around the world as well. And here's the really critical thing that I think people need to understand is that it's not just the United States that uses the dollar. The whole world uses the dollar. The dollar is the global reserve currency, and there's two dollar markets. There's the domestic US dollar market that we use every day. And then there's the euro dollar market. And that is when transactions, credit, commerce takes place outside the United States, and it takes place in dollars. And that market that's called euro dollars. And that market is much bigger than the US domestic market. And that market has incredible amount of demand for US dollars. And a lot of people know about the United States owes 30 trillion, which you just brought up, which I think will get bigger. But what most people don't know is that the rest of the world owes over 30 trillion as well. And they owe it in addition to owing money in their own currencies, they owe over 30 trillion in US dollars. And that is a currency that their central banks don't have a ability to create out of thin air. They don't have the ability to print it, right? And so that when the dollar gets stronger versus these foreign currencies, when these foreign governments have to pay their US dollar debts, or when these foreign corporations have to pay their US dollar debt, that as the dollar gets stronger, it makes it harder to do that. So let's pretend that you owe $100,000. You buy a house and you owe $100,000 and it's in dollars. And then over the next year, the dollar gets 10% stronger. But you live overseas, the dollar isn't your home currency. Well, now it's almost like that debt went from 100,000 to 110,000. So, and this is the problem that the rest of the world has gotten in. They owe so much money in US dollars, and they don't necessarily have the easy way to get access to them, especially when the dollar is getting stronger. And that has the potential to cause this crisis that I'm foreseeing. So I actually think I've thought for a while that we will have a currency crisis and a debt crisis on a global basis, but I think it is more likely to start outside the United States than to start inside the United States. Now, again, this isn't to say that the US doesn't have problems. It's not to say that it couldn't start in the United States. It's just that if you play this out into kind of an end game type scenario, I think other countries come under much more trouble and quote unquote have the potential to default long before the United States does. And so I do think we have a debt problem. I think it is going to lead to all kinds of problems. But on a relative basis, I think the U.S. is still in pretty good shape compared to the rest of the world. Not good shape relative to the rest of the world.
That made total sense. Like a light bulb just went off in my head. And so this is when we hear the term dollar denominated debt. And so if you're in another nation and the dollar gets stronger, you're not earning your money in dollars. And so that means that it becomes expensive to maintain that debt. Is that correct? Because the dollars.
That's correct. And the other thing, a lot of people in other countries, they will save in dollars. So, when they get paid, they will go exchange their currency for dollars and then save it in dollars because that's a way to kind of protect a lot of people will do this with gold, especially the United States. People will buy gold in order to protect the purchasing power of their currency losing value. But a lot of other countries, a lot of people in countries around the world, you do the same thing, but they do it with dollars. And here's the other reason that the dollar has a lot of demand is people, entities, institutions around the world, they will hold their cash balances in US dollars. Because again, if you let's say you've got some excess savings, you put $100,000. Let's say you live in Turkey, right? And you hold your $100,000 of savings in US dollars. And inflation rate in Turkey is 18% or 80%. And let's say the Turkish lira loses 13 or 14% versus the US dollar next year. Well, that's almost like you made 13 or 14% for sitting in cash. So again, I think it's really important to understand that it's very much a global economy now, and capital from around the world will always flow to where it gets treated best. And again, it doesn't mean that things are great in the United States, but when you're looking around and you're figuring out where to allocate your capital, the U.S. looks very good on a relative basis. And maybe another way to explain this too is let's pretend that you go to the playground, you're going to pick up basketball. And you get there to the court and there's 9 other guys. And so now we're going to pick sides. Now let's pretend that the 9 other players are horrible. They can't dribble, they can't shoot, they run and they fall down. Well, one of those 9 though is still going to be the best player out of all 9 of them, right? Doesn't mean they're good basketball player. It just means that they're better than the other 9. And that would be the guy that you would want to pick. And so that's kind of how, when you allocate assets, unless you're just going to sit in cash, you're looking to place your assets in the relative best place. And so when you're doing that on a global basis and you're trying to figure out what currency to hold your cash balances in or hold your assets in, the U.S. starts to look very good on a relative basis when you consider everything that's going on in the rest of the world.
Yeah, that's good. So you mentioned the best place may be to have your capital in the United States. So are you less bullish on emerging markets? What's your take on the emerging market sector?
Yeah, I am not bullish on emerging markets at all. I think emerging markets are going to have a very hard time over the next couple of years. So I am not. Now here, I should say something. I don't think that we're going to have this big crisis in the next 6 months and then it's all going to be over. I think this is probably going to take several years to play out. So it doesn't necessarily, when I say I think they're going to struggle, it doesn't necessarily mean they're going to collapse in the next 6 months. And it's possible that they go up over the next 2 or 3 months. But I think over the space of the next 2 or 3 years, emerging markets are really going to struggle relative to the US markets. The way I think about it is that there's 4 different scenarios in my mind. Is that the whole world, perhaps everybody who thinks that we're going to have a crisis or that things are bad, perhaps we're all wrong and the whole world grows together and everything is good, right? That's one scenario. The other scenario is maybe a lot of these people who think that we're going to have a crisis, maybe they're right. And perhaps the whole world goes into the crisis and the whole world goes down together. The third thing that could happen is the US could do better on a relative basis than the rest of the world. That's my thesis. And then the fourth possibility is that the US could have a very significant recession and the rest of the world could do okay. Now, out of those 4 scenarios, I think the last one, the scenario where the United States does really poorly and the rest of the world does really well, I think that is very, very, very unlikely. It's not impossible, but in my opinion, it's so unlikely. I don't put a very high probability on it, so I don't want to bet on that. Under any of the other 3 scenarios, I'm either just as well off or better off by being invested in the United States. And so when I'm looking to allocate capital, the other thing I should say, this isn't from a point that the U.S. is better than everywhere else, and that I only look at U.S. assets. I just think where we're at in the cycle and where we're at in history, I think that is where I want to be right now. However, once we get on the other side of this crisis, in other words, if we have a period of time where things are good in the U.S. and things are bad overseas, well, then the profits that we make in the U.S., then perhaps that would be a good time to go buy these distressed assets overseas. Because I think when we get on the other side of this crisis, then I think emerging markets and some international markets have the potential to grow much more than the United States. But at this point in time, until we get a resolution to this debt problem that I see, I favor being in the United States.
Yeah. So what was happening during, like, after the dot-com bubble? We saw like a run up in emerging market stocks and such. Like, what was happening during that era that made emerging markets so attractive?
Well, part of it is that interest rates were very low and the dollar was weak. And so what I mean by that is whenever you have a crisis, the central bank, the Fed, comes in. So first of all, whenever there's a crisis, the dollar goes higher. I mean, if I can show you a chart going over the last 25 years, whenever there's a global slowdown in economics or whenever there's a crisis, it coincides with the dollar going higher. Now, whether the dollar goes higher in reaction to the crisis or whether the dollar going higher causes the crisis, I'm not smart enough to know that. I just know it's 100% correlation. And so whenever the dollar gets too strong, that's when the Fed comes in and introduces new monetary policy or new fiscal measures or new projects in order to weaken the dollar. And as the dollar falls, that relieves pressure on the rest of the world who borrows in dollars, and it allows them to grow better. And so that's kind of what was after the dot-com crisis. The Fed dramatically cut interest rates. They went to easy monetary policy. That allowed the rest of the world to breathe. That allowed credit to get extended. And that allowed the rest of the world to grow at a higher rate than the United States. But then what happened is, again, growth is based on debt. We live in a debt-based monetary system. So then all this, there was a great growth, but there was great growth of debt as well. And so then when the global financial crisis hit and the dollar got stronger again, it caused defaults all over the world. And so this is a cycle. This is what happens. And then again, for the system to grow, for the global economy to expand, debt has to grow with it. But then that ultimately leads to another crisis. You get a hard downturn, and then the central banks come in again and they start the cycle all over again. So I think we're kind of at the point in the cycle where we're probably going to have another downturn, and then the central banks and the monetary authorities will come in and they'll try to reflate things again. And like I said, we'll have to kind of wait and see when that happens, or if it happens, when it happens, and then kind of what the reaction to it is. But the point is governments won't just sit there while we have a deflationary storm and not do anything. Yeah.
And it sounds like your position for either outcome, as well. So
yeah. So here's what I would say is if I'm wrong and we don't have a crisis and markets continue to rally and they go up and to the right, we will make money. We won't make as much money as the other people who are levered long and like really being aggressively into risk assets, but we'll do okay and we'll make money. But if we get this hard downturn, and even if this hard downturn, maybe it don't last for 6 weeks, maybe it don't last for 6 months, but if we have this really hard downturn, I think that we will weather that storm better than the average investor because I think we're prepared for it and we understand why it would happen.
Yeah. That's a risk management for sure.
Risk management. That's exactly right.
So you mentioned earlier that you have some of your clients' money is in precious metals. Obviously, we see gold at near its all-time highs. The dollar has weakened a little bit, and we kind of see this correlation or this inverse relation between the dollar and gold. So do you think is this the time where gold is going to pierce the triple top that is made, or do you think it's coming back down?
I think it's going to come back down. Now, a lot of times people will say, Brent, if you think that's going to come back down, then why do you own gold? And the reason I own gold is for a couple of reasons. Number one, I don't know if I'm going to be right. I don't know if gold's going to come back down. I could be wrong. And so I think of gold as insurance, and I think of it as kind of the base layer of every strong portfolio. But I don't necessarily, when I own gold, I don't necessarily think it's going to pay off in the next 6 months. And I don't buy it because I think it's going to pay off in the next 6 months. I buy it because I think it's going to pay off over the next 6 years. And so I kind of feel like the gold had a huge run up overnight, made a new all-time high, and now it's pulled back, over $100, $120 in the last 24 hours or 12 hours or whatever it is. So I think it's probably going to pull back a little bit. But again, I think what's important to understand is that you kind of want to accumulate gold on dips, and you don't necessarily buy it because you're trying to get rich. You buy gold because you don't want to get poor. You don't want to get wiped out. Now, the other thing I'd say is when I say buy gold, you don't go out and put your whole portfolio into it. I don't recommend people go all in on anything. I think it's important to have diversification. Have some gold, have some cash, have some stocks, have some real estate. You want to set yourself up to where you're kind of prepared for everything.
Mm-hmm. Yeah, agreed. And what's your take on the gold mining stocks? I mean, those are like, being clobbered up. I'm hearing multiple different sides of it.
Listen, when gold gets into a sustained bull market, the mining stocks will do amazingly well and people will make a lot of money. But my opinion is if you buy gold miners, because then there you are trying to get rich. You're not buying gold miners for safety. You're buying gold miners because you want leverage to the underlying price of gold. And if gold goes up 30%, you want to be up 300%. And if you time it right, that can happen. But the reality is, if you look at a number of different gold mining indexes, GDX, GDXJ, HUI, the Philadelphia Gold Bugs Index, most of them are down since inception. And that's 12 years, 16 years, 40 years. And it's because they're just, I hate saying this because people think that I'm being bearish gold, but they're just not great businesses. And they're really, really hard businesses. And in order for them to be profitable, you need gold to kind of be in a sustained bull market. So I don't own them now. We sold our gold miners back in 2016, and we just haven't bought them back yet. Many of them are still below where we sold them in 2016. I do want to buy them at some point. But like I said, I am not a believer that this is the current breakout. If I'm wrong, then maybe we'll end up having to buy them a little bit higher, but that's my belief as of right now.
Okay. Yeah, makes sense. And then, Bitcoin's been on a tear as well. Do you manage any position in that asset? I mean, because
I don't really manage. Some of my clients have exposure to it, and I've helped them buy it, and I track it for them, and I follow it for them. And again, for us, it's more of a speculation. And I think Bitcoin is probably the best pure play on global liquidity. So if we have a very vicious deflationary shock, I would expect Bitcoin to go down a lot. If we get easy monetary policy where the world is flooded with liquidity, I would expect Bitcoin to do extremely well. But I don't equate Bitcoin to gold. I don't think Bitcoin is going to become a global reserve currency, and I don't think it's as foolproof as many people seem to think it is.
Mm-hmm. Yeah, and that's important. You say that it's tied to global liquidity because when liquidity is up, then Bitcoin and these cryptocurrencies are easier to access for other nations who may not have people in other nations who may not have access to like the S&P or things of that nature. So you do get a lot of speculation into those markets. And so I want to end on President Javier Milei wants to dollarize Argentina's economy and financial system. You specialize in the dollar and banking and stuff like that. I don't know what that even looks like. Is that even possible, or like, what's your take on that?
Yeah. So here's the thing: is they've got incredible problems ahead of them. It's pretty cool to see a guy like Milei win, but he's got incredible challenges ahead of him. He's probably going to have to devalue the Argentinian peso versus the dollar again, even though it's lost an incredible amount already. The dollar is a much more stable currency than the Argentinian peso, and much of the Argentinian economy is already dollarized. It's not officially dollarized, but if you buy a real estate in Argentina, it takes place in dollars. If you buy a car, it takes place in dollars. Anything more than a couple $1,000s, it takes place in dollars in Argentina. And there's huge dollar balances already in Argentina. And I think that that's probably why. And if there was a stable currency such as the dollar, then that would attract foreign capital into Argentina. One of the reasons that Argentina has been kind of boycotted from global capital going there is because the currency keeps losing value. There's a lot of corruption, et cetera. So if you get a stable currency, that could attract global capital flows there. The one thing I liked about what Milei said is he doesn't so much, I think he's being practical when he says he wants to dollarize the economy, because it very much already is dollarized. But what he really said is he would be open to having competing currencies and let the market he's very much a free market guy, and let the market determine what would be the best form of money. Now, I think he's got a huge hill to climb doing this, and I think any politician that tries to implement a system of freely competing currencies and free markets, he's going to have the establishment up against him. But he's got the people on his side. So I'm very interested to see how this plays out, but it's not going to be a smooth ride down there.
Yeah, I agree, because he's the contrarian that's in the space now. It's something new that they haven't experienced in a long time or whatnot. And so, just implementing something new and being that contrarian, it seems like there's going to have to be a lot of mindsets that change, and it's hard to change mindsets of
That's right.
Yeah. Well, Brent, I appreciate you for coming on. Where could people find more about you and your services, and how could people contact you?
So the two places that I'm most active, well, if you go to santiagocapital.com, it basically has my contact information, and it's got a couple of regulatory documents. It's not a big website. It's basically just a contact page. But then we're most active, very active on Twitter. You can find me on Twitter, Santiago Capital. You can also tune in. We have a weekly show that we do called Milkshakes, Markets, and Madness. If you search for that on YouTube, you'll find that. My friend and John Cutsmeta and I do that. So we encourage you to check that out and communicate with us, and we'd love to have you join us.
All right, thank you for coming on.
Absolutely, thank you for having me.